All right, let's go ahead and dive right in. As always, this content is going to be for educational purposes only. All examples and analysis are intended for these purposes and shouldn't be taken as specific investment or trading advice. All hypothetical examples are for the purposes of teaching principles only and should not be intended to suggest any future results. Sorry, I'm trying to do two things at the same time here. The risk of loss in trading securities such as equities, options, futures, and Forex can be substantial. Customers must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and Forex are considered more sophisticated investment vehicles due to higher leverage, and they're not suitable for all investors. Any results that I share today should not be considered typical. Okay, with that out of the way, I need to get Zoom out of the way. And we're good. David, I will share that in just a minute. We're actually going to get to that real soon. Okay, welcome back, everybody, to day 2 of your options trading journey. So we've moved up the hill a little bit. We started from base camp, mixing our analogies again between boot camp and base camp. So we have moved from base camp. Now we're up to boot camp, and we are on to day 2, which is pricing. So we're going to talk all about options pricing today. We're going to understand what are the factors that influence the price of an option. We're going to look at some models for that. And we're going to look at some terminology that goes along with that, what we call moneyness. In the money, at the money, out of the money. These are things that you'll hear me say all the time. And anyone else that trades options, you'll hear that terminology frequently, as well as the Greeks, which are kind of some of the variables that go into the option pricing and how we measure those. And then we'll end up with a discussion of volatility. And then, of course, after that, we have a VIP only session. Right after this class, we have a second class for VIPs, where I will talk about when not to trade options, as well as an open Q&A for our VIPs. So if you guys are interested in joining the VIP session and you are not VIPs yet, then I would highly encourage you. Oh no. Need to copy this link here. There we go. To go. If I can paste. There we go. Go to that link, pasted it there in the chat in Zoom there. So you guys can just click that link if you would like to join VIP. And then you can join us for our second session tonight, and I'd be happy to have you there. Alrighty. So as you guys remember, our bootcamp is all about getting you to the conscious competence level of options trading, where you have gone from stage 1, where you don't know what you don't know, you're unconsciously incompetent, to conscious incompetence, which is about where you are now. We're slightly into the conscious incompetence mode, where you know that there are things that you don't know. So tonight and for the next 2 nights, we are going to be tackling the things that you don't know. And then that will take you to the level where you now know things, but you have to think about doing them, right? It's going to be a new skill that you're learning for at least most of you. So options trading will be something new that you'll have to practice a lot. And through practice, you can then move from the conscious competence stage up to the unconscious competence stage. And again, unconscious competence is not a level that I can get you at. It's not a level that anyone else can get you at. It's not something I can teach you. Unconscious competence just comes through doing it a lot. So you basically just have to practice. And that's how something becomes natural and becomes second nature to you, is through lots of practice and doing it for yourself. So of course, I can't do it for you. You have to get yourself to that level, but I can get you to the conscious competence level where you at least know what to do. And that is what we are doing in the boot camp. Okay, so what's on tonight's agenda? All about option pricing. Now, this is probably the most important module out of the entire boot camp. So pay attention to tonight, because this matters more than the specific strategies you use. Well, really, this helps inform the strategies that you'll choose. And it helps inform everything else that we do with options. And this is how we make our money. So if we don't know how options are priced, we can lose money despite having good setups and all that sort of thing. So we want to make sure that we understand how options are priced, because this plays a critical role in how we buy and sell our options, and it's how we make our money. So to get into that, we're going to talk about the 5 inputs to an options price. We're going to talk about things such as intrinsic value, time value, and the concept of moneyness. Then we're going to talk about the Greeks, and we will end with a discussion about volatility. I have to keep this strictly to an hour because we have VIP session following, so not going to waste any time. Let's get into it. Bill, to answer your question, it's a little after 8 in the morning here. All right, option pricing. The Chicago Board of Options Exchange, the CBOE, standardized the pricing of options in the 1970s using the Black and Scholes model, named after two guys whose last names were Black and Scholes, respectively. Nowadays, options are typically priced using either the binomial yield model or the trinomial yield model or some other similar model. And the reason that we've moved on to other option pricing models is because there's some limitations in the Black and Scholes model. Some of those were that it does not take into account any changes in dividends. It takes into account dividends, but not if those dividends change. It doesn't take into account phenomenons such as IV skew, and the fact that American-style options, which is what most of you and I will trade, can be exercised early. Now, American-style options is as opposed to European-style options, and neither of those things has anything to do with what the stock is or what exchange it's traded on. It's not that all European companies use European-style options and all American companies use American-style options. That has nothing to do with it. I actually don't know why they're called American and European style options, but it's the ability to exercise the option early or only at expiration. American style options can be exercised at any point before their expiration. European style options can only be exercised at expiration. So that's the difference. I don't know where the terminology came about, one being called American, one being European, but it has nothing to do with American or European stocks or exchanges. So that is something to be aware of. All right, last point here, the Black and Scholes model, it's still a great place to start, even though it's a little outdated and we don't use it in our modern day modeling for option prices. It's still a great place to start when we're looking to understand how option prices are decided, because this is where things like the Greeks come about. So if we understand the inputs to the Black and Scholes model, we'll understand how options are priced, even though the later models tweak things a little bit, the foundation is still there from the Black and Scholes model. So we're going to talk about it real quick. For those of you who are mathematically inclined, here's the actual formula for a call option, and feel free to take a screenshot here if you'd like. Ooh, pop quiz. What is a call option? We learned yesterday there are two different types of options, call options and put options. What does a call option give the right to do? Does a call option give the right to buy the underlying security or sell the underlying security? Type buy or sell into chat for me. This is our pop quiz. And a convenient excuse for me to drink more protein shake. All right, everyone is correct. A call option is the right to buy. Good job, guys. You could also have said that a call option is a bet that the stock goes up. That's a very simple way to understand it as well. So hopefully those of you that are nerds among you took a screenshot of this, and this is the formula for a call option. Now, for the rest of us, though, the good news is that you actually don't need to understand the formula to trade options. Don't worry, we're not going to go in depth on that formula or anything if that was scaring you. Now, the Black and Scholes model created a standardized formula for pricing options based on a number of variables. And here's what those variables are, and these are important. So the first is the strike price of the option. And remember, we looked at strike prices last night, and we understood that the strike price is not the price of the stock. It's the price that the contract gives you the right to buy the stock at, right? So we looked at, I think Apple was trading at like $157, and we were looking at the right to buy it for $160. And we talked about how that would only be valuable if Apple was trading above 160, right? Because then we could buy Apple for less than it's trading in the market for. Cool. Then one of the other things that goes into the Black and Scholes model is the price of the underlying security, right? So stocks that cost more usually are going to have options that cost more. So back when Amazon was trading for thousands of dollars per share, their options were quite expensive. Same thing with Tesla. When Tesla was trading up at the $1,000 a share mark, their options were relatively expensive. Now that those stocks are both trading in the 3-digit range, their options are much more affordable. So the price of the underlying security also affects the price of the options on that security. The next thing that affects the price of an option is how much time there is until expiration. We'll go into this a little bit later, but because options expire, we can actually place a dollar amount of value on that time left until expiration. And the more time left until expiration, the more valuable the option is. Next, we have the risk-free interest rate. Now, technically, there's no such thing as risk-free in the world, but in finance, we use short-term treasuries as a proxy for the risk-free interest rate. And we'll talk about why that's important a little later on. And then we also have implied volatility. So implied volatility is a measure of how much the underlying security is expected to move over a given time frame. And generally for the option, it's over the life of that option. Now, out of those 5 variables, out of those 5 things that go into the pricing of an option, only one of them is an unknown. And that, of course, would be implied volatility, because implied volatility is basically just a guess for how much the stock is going to move. All the rest of those are known facts. We know what the strike price of the contract is. We know what the stock is currently trading at. We know how much time there is until the option expires, and we know whatever the current prevailing interest rate is. So we know those things. Implied volatility is the only one that we have to guess at because, again, it's implied. It's not a known factor yet. So in order to understand how the price of an option changes when those 5 variables change, because those are constantly in flux, as you know, well, that's why the Greeks were invented. So what the Greeks are is they're a series of variables that describe how an option's price changes. Now, we'll dive into the Greeks a little bit later on tonight, but first, let's understand a couple of concepts before we dive into the Greeks. So the value of an option, roughly, I know we just looked at 5 different inputs, but if we just look at the overall option price, we can actually just break it down into 2 separate chunks. The first being intrinsic value, and the second being time value. So to put it broadly, intrinsic value plus your time value gives you the total value of the option, or option value minus intrinsic value gives you time value, or option value minus your time value will give you your intrinsic value. Intrinsic value is a lot easier to figure out, so generally we'll be solving for time value out of the 2 of those. But generally speaking, you'll always know your option value. That's just the price on the option chain, right? We looked at those yesterday. You have your bid price and your ask price. And so that's the value of your option. And then we can break those down into the intrinsic amount of that value and the time value amount. So here's what those mean. Intrinsic value is a measure of how much the strike of an option is worth, okay? So to go back to that Apple example that we looked at yesterday, Apple was trading at $157, right? And we had looked at the 160 strike option. So the 160 strike option gives us the right to buy shares of Apple at $160 per share. But Apple was trading less than 160 at the time. So there was actually no intrinsic value in that option because there is no point in buying Apple for 160 when you can buy it in the market for 157, right? Apple would have to be above 160 for there to be intrinsic value in that option. Does that make sense? Cool. So, for example, if you have the right to buy, which again we know is a call option, so if you have the right to buy a stock at 90 and the stock is currently trading at 100, then that call option has $10 of intrinsic value. And the reason for that is you could exercise your right to buy at 90, and then you'd have a stock for 90 that you could turn around and sell to the market at 100 because it's trading in the market for 100. So that would instantly net you $10 per share. So that option has $10 of intrinsic value built into it. Now, on the flip side, if you have the right to buy that stock at 90, but the stock's trading at 85, then that option has no intrinsic value. And it's important to note here that it can't be negative. You can't have negative intrinsic value. It just goes down to 0. So we wouldn't in that scenario have negative $5 of intrinsic value. It would just be 0. Cool. So I hope that makes sense to everyone. Let me know if you have any questions. We're going to move on to the concept of moneyness. So moneyness is a silly word, but basically it just encapsulates these 3.5, 4 phrases that we use, which are in the money, at the money, and out of the money. And then sometimes people use the phrase near the money. So when an option has intrinsic value, we say that it's in the money. So when you hear the phrase in the money, it just means that the option has intrinsic value. So its strike gives it an intrinsic value if you were to simply exercise the option and then go ahead and get rid of those shares. You would then have built-in equity, right? So an option that has built-in equity has intrinsic value, so we say it is in the money. Now, when an option has no intrinsic value, right, when that value would be 0 or negative, we say that it's out of the money. So that's the distinction. And then at the money or near the money options are just those contracts whose strikes are closest to the current market price of the underlying security. So call options are in the money when the strike price is less than the stock price, right? If the stock's trading at 100 and you can buy it at 90, well, that gives you $10 of built-in equity, right? I think that's pretty easy to understand. So that is then in the money. Put options, though, are the other way around. So put options are in the money when the strike price is greater than the stock price, because if the stock is trading down at 90 and you have the right to sell it for 100, well, now you have $10 of built-in equity, right? Because you could buy it at the market for 90 and then exercise your put option and sell the stock at 100. So it's reverse, right? For call options, you want the strike price to be less than the current price. And for put options, you want the strike to be greater than the current stock price. Does that make sense? Are we all on board there before I move on from moneyness? We good? Give me a yes in the chat or something. All right, cool. Thank you. At least Donnell's on board. Okay, let's do a little practice here on our moneyness so that I know you guys are awake and paying attention here. Okay, so we have an example option chain here. Now this stock, when I took this screenshot, was trading at exactly $143. Okay, so is the 135 strike call option, is that in the money or out of the money? This is your pop quiz for today. Your second pop quiz. Mike says out. Gautam says in. Donnell says in. The ins have it. 135 strike for a call option is in the money. What about the 135 strike put option? In the money or out of the money? Right, so the put option is out of the money. So how much intrinsic value does the 135 strike call option have? The stock's trading at 143. Exactly, $8 of intrinsic value in that option because you have the right to buy it at 135. It's trading at 143 in the market, so you could exercise your call option, buy the stock at 135, and then turn around and sell it in the market for 143. And you'll notice that the options here for the 135 strike call options are trading just above $8. So that makes sense. All right. And then what about the at the money strike? Which one is that? Exactly. All right. Well, Tom is on top of it. All right, cool. Barry, you're on top of it as well. I appreciate it. So good. So you guys are picking up what I'm putting down here, smelling what I'm stepping in. Great. Okay. So we will be using these terms a lot throughout the bootcamp and throughout your trading career in general as you trade options. So get very comfortable with the concepts of in the money, out of the money, especially those two, and then at the money is basically where those switch over. Cool. However, as we looked at in this slide, though, an in the money option costs more than its intrinsic value, right? If we go back, we said that these 135 strike calls, they had $8 of intrinsic value, but they're trading here for $8.30 or $8.40, right? And an out of the money option isn't free, even though we talked about it having 0 intrinsic value. So the rest of the option value that's not explained by intrinsic value is called time value. Okay, so that's the two major chunks we have. Now, there is a way to calculate time value that requires a lot of math, but the easier way is to just calculate whatever's left over after intrinsic value. So this gets a little harder when you're projecting into the future, but luckily we have computers that do that for us, so we don't really have to do this at all. Makes our lives much easier. But generally, at expiration or today, it's very easy to calculate what the time value is because we just look at whatever is left over after intrinsic value. So if we look at an imaginary example again, imagine a 90 strike call option that costs $12.40 while the underlying stock is trading at 100, right? So we know that the option has $10 of intrinsic value because the stock price is trading at 100 and the strike price is 90. Right? So we know that we have $10 of intrinsic value there. So that means that the option has $2.40 of time value because the option costs $12.40. We know that 10 of that is intrinsic value. So we subtract 10 out of that, and whatever's left, the $2.40, is our time value remaining on that option. Cool. So generally speaking, you take your option value, subtract out the intrinsic value, and you're left with the time value. Now, time value as a concept is the dollar amount that the market maker is assigning to the amount of time remaining until the option expires. Okay. Essentially, the more time that's left until the option expires, the more valuable that time portion is. So for options that don't expire for a long time, you'll see a very big chunk of time value. Options that expire very soon will have very small amounts of time value. And the reason for that, the reason that longer dated options have more time value is because there's more time for the underlying security to move favorably, right? If you have an option that doesn't expire for a year, well, the chance that the stock goes, let's say, up a lot for a call option or down a lot for a put option, the chance that the stock moves in your favor is much higher over a year than it is, excuse me, for an option that expires, let's say, tomorrow, right? A stock is not going to necessarily move a lot in one day. It can, certainly for things like earnings or, big events. But if you compare that over to the chance for the stock to move big over a year, necessarily we have to say that there's a much greater chance that the stock moves very large over a year than it moves very large over a single day, right? So that's why the more time value is left, the more valuable the option is. Now, thinking about that one step further, then, what you'll notice is that means that options get less valuable as they get closer to expiration, right? So an option that expires in 1 year has a lot of time value left. An option that expires in 1 day has almost no time value left. So that same option, every day that we get closer to that 1 year expiration, every day that goes by, that option is getting less and less and less valuable. So as options get closer to expiration, they lose some of their time value. And this concept, losing that time value, is known as time decay. And this is one of the most important things to understand when trading options. By expiration, the time value of an option is completely gone. It's decayed to zero. So all that is left by expiration date is the intrinsic value of that option. So how in the money it is how much that option is worth. If it's out of the money, all out of the money options expire worthless. So they decay to zero and they're not worth anything by the time that option expires. In the money options, though, will have some value left based on the difference between the strike price and the current stock price. So one critical note on this, even though time moves linearly, right? We move 24 hours a day, 7 days a week. Time decay does not move linearly. Time decay moves exponentially, meaning the value lost to time decay on day 1 is less than the value lost on day 30. So time decay starts off slow and then gets steeper and steeper and steeper and steeper, okay? So this is best described graphically, as I kind of just showed you. So this is a graph of the time value of an option. So the shaded areas that you see are basically the amount of value that we lose to time decay as we get closer and closer to expiration date. So imagine, for example, that this is in weeks. So let's say this is week 1. So we start back here at week 0. This is week 1, week 2, week 3, and then the option expires at the end of week 4, okay? Well, we start up here, right, where we have all of this time value in our options. And this is just looking at the time value of the option, not the entire value with the intrinsic. This is just the time portion. So we start off with all of this time value in our option, right? By the end of week 1, we've lost a little bit of time value, right? We've lost this much. By the end of week 2, we've lost a little bit more time value, right? Now we've lost this much now. By the end of week 3, though, we're starting to lose a lot more, right? Now we've lost, I don't know, maybe 35, 40% of our time value. But by the end of week 4, we have completely lost all of the rest of our time value. So while we started off really slow, just losing a little bit, by the time we get near the end, when the option is very close to expiring, we are losing time value at an extremely rapid pace. So this is working against the value of our option very, very quickly. Now, this graph is going to be the same whether time is in days, weeks, or months. So if you look at this on a 1 week example, right? Let's say that you bought this option on Tuesday. So this is Tuesday, and then we have Wednesday. I'll use that T there. Thursday. Sorry, I did this wrong. Started on Monday, Tuesday, Wednesday, Thursday, and Friday, right? So on Monday, we have all of our time value left for this week. By Tuesday, we've lost a little bit. By Wednesday, we've lost a little bit more. By Thursday, we're maybe 40% gone. But then by Friday, all of the rest of our time value has disappeared by the end of day on Friday, okay? So that graph has two big implications for our options trading, meaning how we want to buy and sell our options. The fact that time decay works this way has two big implications for how we want to buy and sell options. The first is that as option buyers, we should buy more time than we need in order to counteract the effects of time decay, to counteract the effects of time decay. Okay, so to show what I mean, to go back here, if I am buying an option, sorry, I'm all over the place here. So if I'm buying an option, let's say I want to be in this option for 1 week, okay? Well, what I'm going to do is I'm not going to buy an option on Monday that expires on Friday, right? Because if I want to be in this trade for a week, well, I'm going to lose all of that time value. Instead, what I want to do is buy an option this week that doesn't expire for maybe 4 weeks, so that when I sell it at the end of this week, I will still have a lot of time value remaining, right? So even though I'm not planning on holding for weeks 2, 3, and 4, right? I'm not going to hold onto the option this long. The important part here is that when I buy it, there's this much time value remaining. And when I sell it, there's this much time value remaining, right? So by the time I sell this option, I've only lost this much value. So even though this will cost me more to buy 4 weeks worth of time, I will get 3 weeks worth of time back when I sell the option. So it is more valuable for me to do it this way, okay? So people that buy 0 days till expiration options, meaning options that expire that day, or options that expire for basically the entire length of when they expect to hold the option. If they expect to hold the option for 2 weeks and they buy a 2-week option, or they expect to hold it for 2 days and they buy an option that expires in 2 days, it's much more difficult to make money trading options that way because you are giving up so much value in your option by doing it that way. So you're working against time when you do it that way. So when we buy options, okay, not when we sell, but when we buy options, we always want to buy more time than we need. And when we sell that option, we want to have most of that time remaining, okay? So this will minimize the effects of time decay as much as possible because we want to be on the back end of that time decay curve, not the part where it's decaying really quickly, right? We want to be in the part where time decay is hurting us as little as possible. Okay, now on the flip side though, if we sell to open an option, right? Well, that means we're going short the option. And when you go short something, remember, just like going short a stock, that means you want it to go down in value. So with an option, if we are short selling an option, we actually want to get that really steep time decay because we want the option to expire quickly, right? We want that to go down as fast as possible. So that means if we are option sellers, we want to sell the option here, and then we want it to decay to 0. And we either buy it back here or we let it expire worthless if it's out of the money, okay? So when we buy options, we buy back here and we sell here. When we sell options to open, right, when we're short selling options, we short sell here and we buy back here, okay? So this hurts us as little as possible when we buy. And when we're selling, when we're short selling options, we get to capture all of this time decay. So some people like to short sell all the way up here. And yeah, you do get more time decay, but it takes 3 times as much time, you know, like on this graph here, it takes 3 times as many whatever weeks or days, whatever this is, to get like 40% more time value. I would rather capture the lion's share in the shortest amount of time. Let's say that these are in weeks. So I would rather do a 1-week trade here than do a 4-week trade, right? A 1-month trade. So sure, the 1-month trade gets a little bit more time value, but the 1-week trade, I could just do this 4 times, right, over the same period, and I would capture more time decay with that than I would trading a 1-month option and waiting for it to decay for a month. So I hope that makes sense. Cool. So when we buy, We want to buy on the back end of the curve when we have lots of time remaining. When we sell, we want to sell close to expiration and get the really steep part of that time decay curve. So we get the most time decay per day. Okay, so that's time decay. Let's dive a little bit deeper. So intrinsic value and time value are important concepts to understand, but we can go another level deeper and expand on them even further. And that's essentially where the Greeks come in. So remember the 5 variables of option pricing from before. We had the strike price of the option, the price of the underlying security, the time until expiration, the risk-free interest rate, and implied volatility. Now, there are Greeks, what we call Greeks, associated with these variables that tell us how they will change. Now, these Greeks, in order, are delta, gamma, theta, rho, and vega. Now, those are not all real Greek symbols. Some of them are. Delta is a real one, but I know vega is not. I don't think theta. Oh, no, theta is, because we use that in math. But yeah, pretty sure rho is not a real Greek letter. But yeah, so some of these are made up. Some of them are really Greek letters. Some of them just sound like they are. But we're going to go through these one at a time here, and we're going to understand how these work and how they affect the price of our options. So delta is the first Greek that we need to talk about. Delta is very important. Delta measures how the price of an option will change when the price of the underlying security increases. So this measures how your option changes when the stock price changes. Okay. So specifically, delta measures the change in the option price for the next $1 increase in the underlying security. For some stocks, a $1 increase is going to be not a lot if it's a very expensive stock. For low price stocks, a $1 increase will be quite a big change in the stock. So at the money call options and put options actually typically have a delta of 50 or 0.5, meaning that the option will increase in value by 50 cents if the underlying security increases by $1. Okay. So when you buy an option that has the same strike price as the underlying security, it will typically have a delta of 50 or right around 50. Meaning that as the stock goes up $1, the at the money call option then becomes worth 50 cents more. In the money call options have deltas approaching 1, while out of the money call options have deltas approaching 0. Okay. So in the money gives you the most delta, out of the money gives you the least delta, and it goes from a range of 1 to 0, with at the money being right in the middle at 0.5. At the money put options, if we look on the flip side here, have deltas of negative 0.5. In the money put deltas approach negative 1, and out of the money put deltas approach negative 0. So let's look at this graphically. So here's a screenshot of an option chain, and we've got our bid-ask spreads there over on, got it. Okay, so we've got our bid-ask spreads here on either side. We've got calls on the left and puts on the right. So as we look at our deltas here, right, we know that, again, the stock here was trading right at about $143. And if we look at the delta there, you can see it's right at 50. And as we go in the money on our call options, we get closer and closer to 1, right? We go from 5 to 0.6, 0.7, 0.8, 0.9. We're approaching 1 as we go further in the money. As we go out of the money, though, we get lower and lower and lower, right? We get down to 43, 36, 29, 24, 19, blah, 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 right? We get closer and closer to 0. We go down as we go out of the money. So that means these options that are very far out of the money are less sensitive to changes in the stock price than these options that are deep in the money. So if I want to make money on this stock going up, I will make more money by buying deeper in the money options, okay? Because this delta is literally telling me as the stock price goes up, these are going to make me more money. So if I bought an in the money option, let's say I bought the 135 strike call versus buying an out of the money, let's say the 150 strike call, right? Well, the 135 strike call here, if this stock goes up $1 from 143 up to 144, this option will make me 88 cents, whereas this option will only make me 12 cents, okay? So that's essentially what delta is telling me. As the stock goes up $1, here's how much money you'll make. Put options, though, have negative deltas. The reason delta is negative for a put option is because delta measures the next $1 increase in the stock, and put options make money as the stock goes down. So we're looking at how this option will behave as the stock goes up. Well, if the stock were to go up, these put options would lose value, right? And as the stock would go down, those put options would gain value. So necessarily, puts have to have a negative delta because they are measuring the increase in the stock price, but put options make money as the stock goes down, right? So call options have positive delta, put options have negative deltas, but always deltas approach 1 or -1 for puts as they go in the money, and they approach 0 as you get out of the money, with the middle being at 0.5, right at the money. Excellent. So that's delta. Gamma is our next one here. And gamma is a little bit difficult for people to understand at first, but I have an analogy that I think will help. So gamma measures the rate of change of delta. So delta is the rate of change of the option price. Gamma is the rate of change of delta. So those of you that remember your calculus, gamma is the first derivative of delta. Okay, so delta is a derivative of the option, or the option price being derivative of the stock price. Gamma is the derivative of delta, right? Delta is the rate of change of the option price, and gamma is the rate of change of delta. Specifically, gamma tells you how much delta will change with the next $1 increase in the underlying security. So delta tells you how much the option price will change when the stock moves up $1. Gamma tells you how much the delta is going to change when the stock moves up $1. So let's look at an example here. Let's say you've got a call option that's right in the money, so you've got a 50 delta. And at the same time, that stock has a gamma of 10 cents. So let's say the stock moves up $1. Well, the option value we know goes up 50 cents because it had a 50 delta. But now, because we had a 10 gamma, the new delta is 60, okay? So the call option had a 50 delta and a 10 gamma, but when the stock went up $1, the stock, or the call option went up 50 cents because it had 50 delta. Now the new delta is 60 because the old delta was 50, and we add the new gamma, or we add the old gamma to the old delta to get the new delta, right? So the gamma here is telling you how much delta changes. So it changed from 0.5 up to 0.6 because we had a gamma of 0.1. And what this means now that our delta is 0.6, it means that the stock moves up another $1. It means that now our option price will go up 60 cents. So last time it went up 50 cents. If it goes up another $1, it'll actually go up 60 cents this time because gamma added to our delta. Does that make sense? Was that way too confusing? We'll look at an analogy to make this a little simpler. So gamma is going to be, yes, it adds another 10 cents to a total of 0.6, right? In this example. Now we'll have a new gamma after this, and it'll probably be 0.9 or 0.8. So if the stock moves up another $1, our call option will go up another 60 cents. And now our new delta will be like 0.68 or 0.69, something like that. Okay. So gamma is going to be greatest at the money, and it's going to decrease as you get further in the money or further out of the money. So gamma is greatest at the money, and it goes down to 0 as you go in the money or out of the money. Now, the important thing to note here is that delta and gamma aren't accurate beyond the next $1 move of the underlying because their values change as the underlying security moves. So it's not necessarily accurate that you can say, okay, I have a delta of 50. So if the stock goes up $5, my call option will go up $2.50. That's actually not true because gamma will be changing your delta as the stock is moving. So actually, you'll get more than $2.50 as the stock goes up more than $1 as it goes up to $5 because you'll be getting more and more delta with each dollar move. So you actually might get something like $3 in your call option rather than $2.50. So it'll be something like that. Okay, so this is the analogy that I have to help you think of gamma. So imagine a car driving down a long straight stretch of highway, okay? The location of the car at any point in time is like the price of an option, okay? So the price of an option is just the car somewhere on the road. Delta is the velocity of the car, okay? So delta is the rate of change of the car's position, right? Or in our options example, right? It's how fast that option price is changing. Gamma is the acceleration, right? So gamma is the acceleration factor on the velocity. Does that make sense? So that's kind of the analogy that I have. The more the driver accelerates, meaning the higher the gamma is, the faster the car moves, which is the delta, and the further the car travels, which is like the option price, okay? So if we look at gamma on an option chain here, we add it to our option chain. Again, same option chain, but now we're adding gamma to it. What you'll notice is that gamma right at the money here is around 0.72-ish. So that's our highest gamma here, is probably about 0.73 would be perfectly at the money. No, I guess 0.72 would be perfectly at the money. And as we go in the money, our gamma decreases, right? We get close to 0 here. And as we go out of the money, it decreases as well, right? So we're greatest at 0.7, but then we drop off as we go in the money or out of the money. When we look at, whoopsies, when we look at gamma for puts, it's exactly the same, okay? So gamma here is going to be positive for both calls and puts because, again, this tells you how delta changes as the option goes up $1. So this measures the rate of change of delta here. So gamma is going to be positive, and as we go in the money, as we go out of the money, it gets closer to 0 each time, okay? So that's gamma. Basically, gamma is your acceleration factor. Delta is how much the option changes, and gamma is how much that accelerates, okay? So I like gamma quite a bit because you can get pretty explosive moves on an option. When you get a nice strong move in the stock, gamma can really pour the fuel on the fire on your option trade, which is very nice. All right, so let's go to theta now. So theta is our Greek that measures the rate of time decay. So this is a very important one to pay attention to because time decay is something that we are always fighting against when we buy options, or it's something that we want on our side when we're short selling options. So theta, to be specific, measures how the price of the option will change over a 1-day period. Over the next 1-day period, how will that option change in value? Theta is always negative for all options, calls and puts, because time only moves forward. So options only ever go down in value. Okay, so theta is always negative. Now, theta is greatest at the money. So at the money options lose the most time value. And then like gamma, it approaches 0 as you go in the money and out of the money. Now, the only way to benefit from theta, doesn't matter if you're calls or puts, is to be short options. You have to short sell an option in order to benefit from theta. If you are buying options, then theta is working against you. And there's not really anything you can do about that except to sell options, like turn it into a spread or just, yeah, something like that. Some sort of spread usually. Okay, so if we just look at theta here, we can see that our our at the money options here, right at 143, have a theta of about negative 12.5, right? So we'll lose about 12.5 cents on this option just due to time decay. So assuming the stock doesn't move at all, our option will go from being worth about $2.20 to being worth about $2.08 or 207.5 cents. Same thing on the put side here. Again, notice that it's still negative and the amount is basically exactly the same. And this is going to be true as we go in the money, we get closer to 0 on both calls and puts. And as we go out of the money, we get closer to 0 on both calls and puts. On puts, though, remember, this is in the money and this is out of the money. Oh yeah, something cool that I didn't mention that we should pay attention to here. Notice that some of these have a black background back here and some of these have a purple background. This is very common across almost all option changes. Now, the colors might change. It might not be purple and black on your broker platform. On Thinkorswim, it's purple and black. But where this is this easily and visually shows you which options are in the money and which ones are out of the money. So on Thinkorswim, the purple ones are in the money. The shaded ones here are in the money. And black just means they're out of the money. So any options that you see with a black background here are out of the money, and the ones with the purple background here are in the money. And then where it switches over, this is telling you where these options are at the money, right? So these are our at the money options. And so it's very easy to just look at an option chain and instantly see where the in the monies and where the out of the monies are and where the at the monies are, like where that flips. And nearly every option chain on every platform that you'll ever see will have some sort of visual shading to show you which ones are in the money and out of the money. So something to be aware of. Okay, cool. Let's talk about our second to last one here, which is rho. Rho measures the effect of interest rate changes on the option price. This has been negligible for a really long time, but now that the Fed's been raising interest rates, rho is becoming more and more important. Specifically, rho measures how the price of the option will change if the risk-free interest rate increases by 100 basis points. For those of you that are not familiar with Fed speak and that sort of thing, 1 basis point is 1/100%. So 100 basis points is 1%. Now, a 1% change in interest rates is pretty large, especially when we've had very, very low interest rates for so long. However, as you guys know, we're up to like 4.5% or something like that. Rho is negligible for trading in a low interest rate environment like we were in for a very long time, but it might matter for things like leaps, which is long-term options that expire for more than a year, and when you're in a rising interest rate environment like we've been in. Rho is going to be positive for calls and negative for puts, meaning that call options benefit from interest rates going up, while put options get hurt by interest rates going up. Rho is greatest in the money and approaches zero as you go further out of the money, just like delta does. And it is, Rho is going to be small for options that expire soon, but greater for longer term options. So the more time until expiration, the more Rho will have an effect on your option, because again, there's more chance that interest rates change over a long-term position than one that expires very soon. So here I had to kind of break up the options chain to give you two different examples here, right? So here we're looking at options that expire in 8 days versus here we're looking at options that expire in 561 days. So if we look at Rho, and let's just take the 143s, well, nope, let's do the 145s because 143s don't exist out here in a year. It goes from 140 to 145. So if we look at the 145s here, for 8 days, you can see that it's 1 cent, right? 1.24 cents here in Rho. Whereas out to 145 or out to 561 days, now these are being affected 81 cents if option rates or if interest rates change. Okay. So that's basically it. They're much bigger as you go further out in time and much smaller as you're close in time. Again, positive for calls, negative for puts. And that's all we have to know about for Rho. All right, last one that we're going to talk about here is Vega. So Vega measures the effect of implied volatility changes on our option price. Specifically, it measures how the price of the option will change if implied volatility of the underlying security increases by 1%. So Vega is positive for calls and puts. It's greatest at the money, and it approaches zero as you go both in the money and out of the money. So Vega being positive for calls and puts means that no matter what, when volatility increases, options across the board go up in value. And when volatility drops, options across the board go down in value. This is important to understand. This explains why you can have, for example, a call option that where you're betting on the stock going up and you would be making money from the stock going up. And then you see a stock go up, but your call option just kind of went flat, or maybe it even lost a little bit of money. And you're sitting there scratching your head going, well, why does that happen? It's because generally when stocks go up, implied volatility goes down. So you have delta working on your side here as the stock goes up, but you have Vega working against you as implied volatility is dropping. So the net result of these, depending on how sharply volatility drops and how sharply the stock goes up, you might end up in a position where your option actually doesn't make any money, even though the stock went up, or it even loses some money if volatility dropped too much. And so because of that, that kind of dictates how we want to trade our options. And we'll talk about this in just a second. So understanding Vega requires a greater understanding of implied volatility, which is what we're going to talk about to wrap things up tonight. But to look at Vega here, basically, we've got greatest Vega right here at the money, right? We're around 0.9, almost 0.09, excuse me. So about 9 cents of change for these options if implied volatility were to go up 1%. And as we go deeper in the money, volatility has less of an effect on our options. And as we go out of the money, same thing. Implied volatility has less effect on our options. We get closer to zero as we go into or out of the money. Same thing true on puts. And notice that Vega is positive for puts as well. So put options will increase in value as implied volatility goes up, as will call options. So all options go up when volatility goes up. All options go down when volatility goes down. These are important things to understand because volatility changes quite a bit. Okay, so let's talk about it. Volatility is a measure of how much something changes. Really, that's all volatility is. Now, as traders, our profit potential comes entirely from volatility, right? If you imagine a stock that never moved, right? It just, every day it opens at $100 per share, and then it closes the day at $100 per share, and it never goes up or down during the day. Is there a lot of opportunity to make money in that stock? As I'm sure you guys are saying, no, of course, there's There's no way you could make money buying a stock at 100 and then selling it at 100, right? So we need stocks to go up and down in order to make a return. And this is especially true when we're buying options. Now, technically, if you're selling options, yeah, you can make money from time decay, you can be delta neutral, blah, blah, blah. I get that. But broad picture here, generally speaking, volatility is something that we need as traders, right? We need stocks to move. So volatility is absolutely necessary for a trader. And there are two ways that we measure volatility. There's historical volatility, which tells you what happened in the past. And there's implied volatility, which is what we expect to happen in the future. Now, implied volatility is the only input into the options pricing model that is not a known fact, as we talked about before. And that's why it's called implied, right? We're implying what the volatility is going to be. And it's set by the market makers. And essentially, it's just their best guess for how much the underlying security is going to move in a given period. And there's a lot of things that go into implied volatility. They don't just pull it out of thin air. Market makers have very sophisticated models for calculating implied volatility. But basically, implied volatility will change, right? As conditions change, the implied volatility is going to change, because if a stock that was quiet starts getting a lot of news, a lot of activity around that stock, necessarily volatility is going to go up because the stock's going to start moving a lot more. Whereas when a stock has been moving a lot and starts getting quieter, implied volatility is going to drop, right? Now, it's important to note when you look at implied volatility, when you look at the actual number, it's always expressed in annualized terms. So you might be looking at an option that expires in 30 days, and it might say something like 43% volatility, right? Implied volatility. That doesn't mean that the stock is expected to move 43% in the next 30 days. What it means is that the amount that that stock is expected to move over the next 30 days, if you annualized that over a year, would be 43% movement. So it's always in annualized terms. So don't look at that number expecting that's how much the stock is expected to move in that time period. It's not. It's an annualized number. So if you want to know the actual expected percent move of a security by that expiration, you have to kind of reverse engineer it. There's a formula to do that, which we're not going to get into. But if you guys are super curious, I can share that for the nerds out there that want to do that. And I'm a nerd too, so I'm not disparaging anyone when I say that. I have done this. I've backed out the expected move from that. I have a little spreadsheet that has the calculation in it, and I just plug it in. And it does that for me. It's quite nice. But it's not something you need to trade options by any means. It's just kind of something you're like, oh, that's nice to know. And if you are trading on Thinkorswim anyways, or most robust platforms, that expected move is already on the platform. So you don't need to go into a spreadsheet to figure it out. They put it in the software there for you. So high implied volatility means that the market makers expect the stock to move a lot over that time frame. Okay. Low implied volatility means that they don't expect the stock to move much at all. This is important. Retail traders tend to look at this and do the exact opposite. So what a lot of retail traders will do, will look at implied volatility and say, oh, implied volatility is low, let me buy options. So the problem is they're buying options because implied volatility is low. And what they don't realize is that implied volatility is low because the stock's probably not going to move, right? So if you're buying options, like God forbid you buy a straddle on a stock, and you're like, a straddle expects the stock to move very big. It's very expensive. The stock has to move a lot for a straddle to pay off. If you are buying options on a low volatility stock and you're buying a straddle, well, you are giving yourself a very hard chance of making money, a very low chance of making money, because you're buying a stock that the market maker is telling you, hey, the stock's probably not going to move much over expiration. And you're buying options saying, I think it's going to move a ton, right? So you're basically saying you know something that the market maker doesn't, and I can almost guarantee you that you don't. Market makers know what they're doing. They track a specific number of stocks. They know pretty much everything that's going on with that company, probably a lot more than you do. They are plugged into this. They do this all day, every day. This is their job, right? So market makers almost certainly know what's going on with the stock more than you do. Implied volatility is priced lower high for a reason. So please understand that. The other thing retail traders tend to do the opposite of is that they sell options when implied volatility is high, just kind of willy-nilly. And they don't really realize that that high implied volatility means there's a much greater chance that the stock moves against them. And when you sell options, you are generally risking more than you are standing to make. So it's usually not a good risk-reward trade-off. Now, we'll talk about why you would sell options. Just because the risk-reward isn't good doesn't mean we don't sell options. I sell options all the time. It's a great strategy. But there's good ways to do it and there's bad ways to do it. It's a mistake to look at a stock and just say, oh, implied volatility is high, let me sell options on it, okay? So there are ways to use implied volatility to our advantage. And in general, we do want to buy low and sell high when it comes to implied volatility. But the big but here, the important thing to remember is that low implied volatility by itself is not a reason to buy options. And vice versa, high implied volatility alone is not a reason to sell options. So you have to consider why a market maker would price implied volatility high or low for a security. So you might not know. Let me go through some examples. Here are some reasons why implied volatility is low. The most important one that is going to be the answer most of the time is because there's a lack of catalysts before that option expires. Okay, so the option expires, let's say next week, and market makers are looking at the stock saying there's no announcements coming out from the company before next week. They don't have earnings before next week. There's no big court settlement happening. There's no FDA trials that are coming due before next week. Like there's nothing happening in the stock before next week that is likely to push the price significantly higher or lower, right? So they're going to say, all right, there's not really a reason for the stock to move. It will have normal day-to-day price movements just from normal buying and selling, but there's no catalyst, right? There's no event happening to drive the price higher or lower. The other reason could just be that historical, meaning realized volatility, is going down. As realized volatility goes down, well, necessarily we're going to decrease implied volatility because generally that means you had a stock that was moving a lot and is starting to get quieter. And so market makers are going, okay, the stock used to move a lot. It's getting quieter. So we have to assume that it's going to continue to stay quiet until something happens, until there's an event or a catalyst that is going to move the price higher. On the flip side of this, the market maker could just be long a bunch of options and they have to lower implied volatility to reduce their risk. Welcome to the financial world. You have no control over that. It's just something that you have to live with. But the thing to keep in mind here is that low is not the same as cheap, okay? We don't buy options just because implied volatility is low. You have to have a better reason than that. All right, reasons why the market maker might price implied volatility high. Well, there could be a lot, or at least one, market and or stock moving catalyst before expiration. So for example, there's earnings coming up on the stock. There's an FOMC meeting happening in, that's going to affect the whole market. So necessarily it's going to affect your stock. There could be a court decision for some whatever lawsuit that they're involved in that will be decided before the option expires. There could be the result of a drug trial coming out for like a biotech company or something, right? An FDA result. Like all of these things can move the stock before expiration. So implied volatility is going to be higher when those are happening because the market maker knows, hey, when that event happens, the outcome of that event is likely to drive buying or selling pressure on the stock. Could also just be that historical, meaning realized volatility, is going up. So the stock is getting more and more volatile. So necessarily we have to expect that that is going to continue, at least in the short term. So implied volatility will go up as well. Could also just be the case that the market makers short a bunch of options. They have to raise implied volatility to stay neutral. Again, you have no control over that. That's just welcome to the financial markets. So always remember, though, that high is not the same as expensive. We don't sell options just because implied volatility is high, okay? Don't get caught on the wrong side of this. The important takeaway here is that implied volatility is not arbitrary. It is priced high or low for a reason. All right, chances are the market maker knows more than you do about the stock, and that's why they are pricing that implied volatility high or low. So instead of just buying because IV is low or just selling because it's high, what we want to do is buy when implied volatility is going up, not necessarily just because it's low. We could buy when it's middle. We could even buy when implied volatility is high, as long as we expect it to keep going higher. And generally speaking, we want to sell when implied volatility is going down. All right, that's it for option pricing. Those of you who are VIP can join me in a few minutes for our special VIP only session. We'll switch over to a new Zoom room. We'll continue the discussion there. I need to take a break to fill up and get something to eat real quick, and then we'll continue. So we'll have a couple minutes in between, but here's the link for anyone that is not in VIP yet. This is basically your last chance because we're about to start our first VIP session. So if you want to join us, then I will switch over. We'll start that in about 5 minutes here. And yeah, I will see you guys there. Otherwise, that's been it for day 2. So I will see the rest of you, you non-VIPers, you filthy non-VIPers. Sorry, excuse me. We'll see you normies. We'll see you tomorrow for our class number 3, where we're going to look at our very first options buying strategy using all of the things that we've learned so far. We'll kind of encapsulate this all into how we want to go about buying our first options strategy. And yes, these recordings will be in our TSU membership area, what we call the Student Learning Center. So we'll get those there for you guys. Cool. I lost you on row. Row is interest rate changes. So just measures how the option price will change as interest rates go up. Okay, cool. I'm going to go ahead and end this room. I'll see you VIPers in about 5 minutes here. And oh yeah, quick reminder, what all you get with VIP, you get the additional live sessions, which we're about to start our first one. You get the recordings and notes, of course, for all the VIP sessions in addition to the regular ones. You get VIP only Q&A time. We'll have our first one tonight. We'll also have some additional option strategies, so you'll have even more strategies that you can use at the end of the week here. And then it also comes with some bonuses and additional video, as well as the guide, in order to help you get started trading options even easier. And if you are interested in continuing on with the accelerator program, which we haven't really talked about yet, but that's where I like trade options live with you. We do that over a full quarter. VIP attenders for the bootcamp get 20% off of that, which more than pays for the bootcamp by itself. So the link, Bill, is in, or Billy, I should say, is right here. So it's in the chat. So just click on that and it will take you to the VIP upgrade page where you can upgrade to VIP. Definitely make sure you use the same email. If you do want to upgrade to VIP, use the same email that you used to sign up for the bootcamp here. That will just make everything much easier. Okay, so I'm going to go ahead and close this. You guys have the link there in chat. If you do want to join VIP, I will go ahead and start the VIP room, and I'll be back in about 5 minutes here. So I'll see you guys in just a few minutes.